managing your own investments versus working with an advisor, when should you do Roth conversions, company retirement plan changes, and what should you do? And does having multiple IRAs make you diversified? These are all great questions that we've received and we're going to respond to in today's episode. So stick around as my responses could really help you in your financial future.
Welcome to the Your Life, Your Money podcast with Scott Searins, teaching you how to thrive in life, wealth, and retirement.
Welcome to the Your Life, Your Money podcast. I'm your host, Scott Searins, and in today's episode, we're going to be responding to listener questions, covering topics such as Roth 401ks, Roth conversions, whether or not your portfolio is diversified, what does diversification mean versus tax allocation, and then do you need a financial advisor? So a lot of great questions that came in. Listen in as we'll be able to learn together. You might find yourself in a similar scenario or situation and be able to take the thoughts, strategies, actions discussed in today's episode and be able to implement them into your picture. Now, whether you're a first-time listener or a long-time listener, if you find today's episode helpful, please leave us a review. That way it can help others find the podcast as well. Plus, don't forget, check us out on lifemoneyshow.com. That's lifemoneyshow.com to see additional podcasts, blogs, videos, all to help you build wealth and to improve your overall financial future. Before we dive into today's questions, there's an article that I was reading in Market Watch that just kind of triggered some initial thoughts for me that I wanted to share to make sure that we're all checking up on something. And the article in Market Watch was, many companies are enriching their retirement benefits. Again, we'll link to the article in the show notes. You can go to lifemoneyshow.com and look for the article in the show notes. But it says, many companies are enriching their retirement benefits. Couple paragraphs here. One, it said workers may be in for a treat. Some companies plan to boost their retirement benefits in the next years as they look to hire and retain talent, according to a new survey. Another paragraph talked about different benefits such as different contribution types, companies that might have suspended their 401k matches in the past, now restoring these matches in the futures, allowing employees to contribute to student loans or being able to build up an emergency fund at their company or within their company plan. So the reason that I bring this article up, or what it triggered for me, is to ask you, when is the last time that you and your advisor reviewed your retirement benefits? And all too often I find that, we just kind of go or get in that natural, flow of work and just doing things. And sometimes your retirement benefits can be forgotten, or you got an email from them and it's like, oh, okay, that's, kind of sounds like a lot of terms that I'm not really sure or aware of. And so you kind of just, ignore that email. But this can make a huge impact to your future. So first off, when's the last time that you reviewed your retirement benefits? In addition to that, if they've changed or upped the company match, are you getting the full match? I'm going to share a quick story with you. I had a client in which we, reviewed their retirement benefits, and to get the match, they needed to contribute a certain amount each and every year, right? And when we actually calculated how much they were contributing, they were short of that amount by a couple $100. So they actually weren't getting the company match. Sometimes people look at that as free money, right? That's a contribution that the company is making to your retirement from their profits, not from your money, from their profits. And so make sure that you know and understand what the company match is, and are you putting in enough to get that full company match? Also, has your company maybe changed their offerings? Are they now offering a Roth 401k in addition to the regular or traditional 401k? And have you analyzed and decided which one of those two that you should be putting your money, your future retirement savings into? The other thing that I found is sometimes new companies could potentially take over your 401k plan. For instance, it may have been with Vanguard, switched over to Fidelity. It may have been with Prudential and switched over to Vanguard. Or, pick the companies and fill in the blanks, right? But sometimes your company will actually change whom is managing the 401k. And again, you could throw in 403b, 457, but who is managing the retirement plan? And if so, have your investment selections changed? And a lot of these companies, when they switch, right? So let's just say you're moving from, I'm just making up some names here, right? But let's just say you're moving from Prudential to Vanguard. A lot of them will say, okay, here's where you're at today and the investments that you're in. Here's similar investments at the new location. And we're going to take you from here at location A and over to location B into these similar investments. But if your company made that change, have you actually checked up on to make sure that your money actually went into those new investments? And did you actually check to make sure that those new investments still make sense for you? Are those the lowest cost investments available to you to actually achieve the goals that you want to achieve? So just reading this article, it triggered some thoughts for me that I wanted to share with you to help make sure that you are on the right track. A lot of companies updating their company retirement plans to continue to stay more competitive. If yours is being updated, have you looked at what those updates are? Or when is the last time you reviewed your company retirement plan benefits to make sure that you are fully taking advantage of everything that you can within the plan? All right, hopefully you found that helpful. And with that, let's move on to some listener questions. That way we can all learn together. Now, the first isn't a question from a specific listener. It's actually questions that I've gotten in multiple of our strategy meetings. Right now, I'm going through strategy meetings with all of our clients. What that is at the beginning of the year, we sit down and we talk about financial strategy, retirement strategy, how much income that they might need in the future, what their retirement withdrawals look like, what those retirement paychecks can be, and are we allocating our investments in the proper ways to make sure that we can help those clients meet all those goals. Anyways, just want to kind of give you an overview there of what that strategy meeting is. But one of the questions that I've been getting, because with a lot of our clients, we annually review and do tax strategies. And typically that's towards the end of the year. So one of the questions that I've been getting, because we just did this last October, is, hey, Scott, should we be doing those Roth conversions again? And should we do that right now? Let me break this down to help you understand what first a Roth conversion is. What a Roth conversion is that, let's say you've got money in your 401k, IRA, 403b, in that bucket where you have yet to pay any tax on that money. A Roth conversion is taking money out of that bucket and putting it into that tax-free bucket, that Roth IRA. So you're taking from your IRA, putting into the Roth IRA, taking from your 401k, putting into the Roth IRA. Now, be very aware, when you do a Roth conversion, you have to pay tax on that money today. And then once you get it over into the Roth bucket, it then grows tax-free, and all of your base plus all of your growth can be withdrawn tax-free in the future. So why is this something that we do, or how do we think about it? And you might be thinking, oh man, should I get all of my money over into that Roth bucket? Because it sounds so great, because we can, it grows tax-free and we can withdraw it tax-free. Well, first off, we don't do it all at once. Our goal is very strategic. What we're trying to do is help clients maximize their tax bracket. So I want you to picture in front of you 4 different buckets. And all of these buckets are actually tax buckets. And you've got your 10% tax bucket, your 12% tax bucket, your 22% tax bucket, and your 24% tax bucket. Now, the way taxes work is that if you pictured all of your income in this 5th bucket, right, you're going to start pouring your income into each bucket, and then when the 10% one fills up based on the income brackets, then you got to start filling up the 12. If that one fills up, you start filling up the 22, and then you 24, and so on. It's all based on how much income you have coming in. Well, what we like to do is at the end of the year is review how much income each of our clients has coming in. And so we take, again, that fifth bucket with all their income, start pouring it out. How much went into the 10? Well, 10 filled up. How much has gone into the 12? And maybe that 12% bucket got halfway filled up. So a thought or a strategy then, right? So all of their income in that fifth bucket, right? It only filled up halfway up to that 12% bucket. So a Roth conversion strategy is that, okay, well, we now still have room left in that 12% bucket. So let's take out some from this IRA, 401k, and convert it over to the Roth. And as we do that process, right, it's going to fill that bucket up some more because you have to pay tax today to get it over into that Roth account. And so we look at how much is left in that 12% bucket to help us determine, how much do we want to convert. And I'm using 12% as the example. For some clients, we're filling up the 22% bucket. For some clients, we're looking at how do we max out the 24% bucket. Each and every one of you have a different scenario, and it's all based upon your income, your scenario, and where you have your money saved. The answer to the question, let me go back to that now so you've seen the full process, but the answer to the question of should we be doing our Roth conversions right now, meaning in March, the response that I'm providing to my clients is that, hey, we want to wait until October, because in October we'll have a much clearer picture. Again, back to those 4 tax buckets in front of you, we'll have a much clearer picture of the income that you've had come in, right, from January through October, and where you'll fall, meaning like which buckets have filled up and how much you've filled up each bucket. The trouble with doing a Roth conversion now, and not trouble, but the potential concern with doing a Roth conversion now in March is, let's just say we're like, okay, you're like, hey, you know what? I'm on a pretty fixed income. I've just got my Social Security and pension coming in, and that's all that's coming in. So I know how much this room's going to be left over. That fills up the 10% bucket. Scott, it fills up the 12% bucket, and it goes halfway up on the 22% bucket. So let's do a Roth conversion. And you could, right? You could take that chance, do the Roth conversion and fill up that 22% bucket. But here's my question is, there's a lot of what ifs, right? So what if something happens and you need to make a big withdrawal now from your IRA, and that withdrawal puts you now into that 24% bucket? Well, that Roth conversion, if you would not have done that Roth conversion, you may have been able to keep that withdrawal in the 22% bucket. So that's the only thing. That's the reason why I say to wait. By the end of the year, you'll have a really good sense of how much income that you've got coming in. We can do a projection of how much you'll have by the end of the year. We're a lot closer, and we can determine how much that Roth conversion should be, if any. Again, it doesn't make sense for everyone. It all depends on where you have your money saved and how much money you do have saved. So hopefully you found that helpful in regards to Roth conversions. If that's going through your mind right now, I just say, hey, keep it in your mind, but table it until October, and that's a great time to take care of it. We take care of it then with all of our clients in our year-end planning and tax strategy meeting. Okay, our next question here is from Tom. Tom says, I have an MBA and I understand investments really well. So I've always handled my portfolio myself instead of having any professional help. And I've always done very well. In your honest opinion, is there really any reason for me to work with an advisor? Tom poses a great question in regards to, hey, should Tom work with an advisor or not? Tom feels really comfortable managing his own investments. I want to break this down into 3 parts as I provide you my thoughts and my 2 cents here. Part number 1 is, what are your needs and what is it that the advisor provides? And here's the thing. If all you think an advisor does is investments, Well, I could see why you, Tom, or anybody else in Tom's shoes might think this way. This is going to be probably a really bad analogy, but just follow me for a second, right? If you are just a huge breakfast fan, right, and all you think about is breakfast, and so the only types of restaurants that you go to are restaurants that all they do is only breakfast, well, you might not ever think about, hey, there might be some really good food out there. There might be some really good things out there and some restaurants that also do like lunch and dinner, but they do lunch and dinner, but they could serve you breakfast too, right? So like I said, maybe not the best example, but if all you think about is investments, right, then you may just think that's all an advisor does and wonder why you could need their help. Now, I can't speak for all of the different advisors out there. There are some that just sell products. There are some that just do investments only. What I do is holistic planning and wealth management. So what I can, help you with is go through our services here, help you understand what we provide, and then you can say, oh, maybe I do need some of those services, maybe I don't, and help relate to you. But I find all too often some people can get very, into this question of, well, do I need an advisor to, I love to manage my own investments. So again, back to part one, what are your actual needs and what do the advisor provide? What does the advisor provide? And there's lots of different advisors that provide different services. We take a very holistic approach, meaning income planning, doing an income plan for our clients, meaning looking at all of their current and future sources of income and what does that mean to their future, meaning how big of retirement paychecks will we need to cut in the future? How do we cut those retirement paychecks? How can we maximize those retirement paychecks? When to take Social Security? How much should we be saving to hit those future goals of whatever type of retirement paychecks that you need? I was just working with some clients the other day in which, they know that their current income needs are, let's say, $8,000 a month. Well, based on how much they've saved up, they are on track to hit that $8,000 a month that they would potentially need in their future. But they're saying, hey, we also want to take some vacations. We also want to do this. And they've listed out some other goals. Well, to hit those other goals, we now need to increase that savings, right? The amount that they're contributing prior to retirement. So income and savings planning is something that we do. Maybe, Tom, you need help with that? Maybe not. The next part is tax planning, tax strategies. How do we help keep more of your money in your pocket versus giving it to the IRS in taxes? So are you contributing your money to all of the right tax buckets? There's a taxable bucket that you can be contributing money to. Lots of different types of accounts there, brokerage account, checking, savings, CDs. There's the tax deferred bucket, IRAs, 401ks, 403bs, and then you've got your tax free bucket, Roth IRA, Roth 401k. So, are you contributing to the right tax buckets? That's something that we help our clients with. I find all too often people have been conditioned to put all of their money into their 401k, and what they don't know is they're actually setting themselves up. Again, this is all dependent on how much you've saved, setting yourself up potentially for a future tax trap, meaning when you turn age 72, you have to start taking required distributions from that bucket. And based on how much you saved, you could actually be putting yourself in a higher taxable income in the future than where you're at today. Roth conversions, we talked about that in strategy or in the first question. And then, so from a tax standpoint, do you need help with that? Maybe yes, maybe no. Investment management, aligning your asset. So you're saying, hey, I'm doing a great job. I can manage my own investments. But are your investments aligned with your income plans? Are your investments aligned with your future income needs? Are the assets in there, right? Stock, bond mixture. Some people call them equities, right? Is your growth, safety? I call it a lot of different things, but is your asset allocation aligned with your future needs? And then are you properly diversified within that asset allocation? Sounds like that's something that you're really strong in. But maybe I've brought up a few points here where you're like, boy, I really haven't thought about how do I align this with my income plan, with my tax plan. The other two parts here are health planning, so Medicare planning, long-term care planning. It's just unfortunate, but a lot of us will need some form of help and support in our future, in which, just part of the natural aging and maturing process that we'll no longer be able to fully care for ourselves. And long-term care is a very expensive thing. It's a very expensive service. And have you thought about that? Have you planned for it? Do you need long-term care insurance, or do you feel that you can self-insure? And then the last is legacy planning. I find that most of my clients, they don't want to run out of money, and we don't want them to run out of money. That means that there's going to be something left at the end of the day to go to, whether it be their children or a beneficiary. And we want to make sure that that happens in the most tax-efficient way possible. So part one of your question here, Tom, let's just wrap up. I'm kind of summarize that is, what are your needs? And there are advisors out there that provide different services. As you can see, we provide a holistic type service, meaning income planning, tax planning, investment management, health planning, legacy. But if you're just looking at an advisor that all they do is investment management, well, I could see why maybe you would be like, yeah, that's not a great fit for you. Maybe you don't need all of the services that my company provides, and so that's not a great fit for you either. So for anybody out there listening, it's what are your needs? And then you need to find an advisor that provides those types of services. Okay, part two here, Tom. Is there any reason for you to work with an advisor? Well, an advisor also sometimes acts as a behavioral coach. So my question to you, Tom, and my question to everybody out there that likes to manage their own investments is, do you feel that you'll be able to stick with your investments when the stock market or your investments are down 10%? How about 20%? How about 30%? As I'd mentioned, right now, we're going through strategy meetings with a lot of our clients, and a big part of that strategy meeting is reminding them and going over the strategy that we've created in their portfolio of having the war chest that aligns with their income plan, right? A pool of funds that's not subject to volatility. So as they need their income, as they want to go on those vacations, as they need those retirement paychecks, they have that ability to do so. But then we also have our growth portion, right? That is, yes, at more risk, but for potentially more gain over that longer period of time. So do you have a strategy in place that you will be able to stick to? And not only will you be able to stick to it when the assets are down, when your investment portfolio is down, but are you also able to stick to that plan when things are really good, or when you're hearing your neighbor talk about a certain stock that's just knocking out of the park, right? Because that's the other trouble that I see happens over time is, well, we hear our neighbors say, hey, you should, I put some money in, pick a stock, right? Any name. I put some money in this stock, and boy, I'm really knocking it out of the park. So do you ever see that your plan, right, starts to become, I'll say, garbled up with miscellaneous stocks because you're trying to chase the next hot thing? Because that's how you can sometimes overperform, which is good, but that's also how you can sometimes really underperform, not such a good thing. So if you can answer, yes to all those questions, you can stick with your plan, you can stick to the investments when they're down, that is great. Maybe you're able to do it on your own. If not, that's the other point of having a really good advisor, somebody who has a strategy in place to you, specific to your plan, specific to your needs, and is going to help you stick with it through the ups and the downs in the market. If you're really not sure, I think I would, say, hey, go back and ask yourself, what happened in 2008? How did you feel? What happened when, the pandemic hit of 2020 and you saw your stock shift? How did you feel? For our clients, we had a strategy in place. We had that war chest growth strategy in place. How did you feel? I received multiple phone calls, at that point in time from people who they thought they could manage on their own, but then what did they do? They ended up selling out to cash. And who would have known in 2020, right, that the downturn was only going to last 2 months and then turn into this huge, upswing after that. And those people that sold out to cash, most likely they were not able to get back in to enjoy all of those upswings. And that's what, it's that short-term perspective that can really harm your potential long-term results. So that's part 2. And then I said part 3. All right. So part 1, what are your needs? Part 2, can you stick with your plan in the downs and the ups and when everybody else is telling you that all these other things might be doing great? And then part 3 is, what are your investments for? Having investments is great, but what do they mean to you? Meaning, do you have a plan for that money? Maybe it's to buy an investment property in the future. Maybe it's to just create paychecks. Maybe it's, to help your children out or help your grandchildren with their college education. What is the money for? I find sometimes that we can get just so engrossed or so consumed with having the money, but that's great. It's just sitting there in an account or sitting there on paper. What is the actual money for? And that's the other reason to potentially work with an advisor, is to actually create and have a plan for that money. So Tom and everybody else listening that manages their own investments, hopefully I've just brought you some thoughts here in regards to, would you or should you work with an advisor? Again, the answer is for you to determine based upon your needs and the services that you need as well. Okay, let's move on. Our next question here is from Brad. Brad says, they recently announced at work that our 401ks are now going to have a Roth option. Should I put my future savings in that, meaning in the Roth option, instead of the traditional 401k option? Hey, Brad, great timing on your question. And I guess from our article earlier here, Brad is really paying attention to when his company is making changes to their retirement plan. Really important, as I mentioned earlier, make sure we're paying attention to that. Okay. First off, let's understand what is the Roth 401k. The Roth 401k is similar to a Roth IRA, is you put money into it today. And when you put the money in today, you're going to pay tax on that money today that you put in. The Roth then grows tax-free, and you can make withdrawals from the base, the amount that you put in, plus all of the growth, tax-free. So let me just give you an example. Let's say Brad puts in over time $200,000, right? And then based on how Brad's invested over time, that $200,000 grows to $500,000. The $200,000 that Brad put in, plus the $300,000 of growth. In the future, Brad can take all of that out, the $200,000 he put in, plus the $300,000 of growth, he can take all of that out tax-free. Pretty good, right? So how do you decide on, which should you put it in? Because, boy, the 401k, you get that tax reduction today, the traditional 401k. So let me give you a few thoughts here. For a person that's young, maybe in your 20s and 30s, and you might be in a lower tax bracket, now is actually a really good time, while your taxes are low, to really focus on that Roth option, especially if you feel like taxes will go up in the future. So if you think taxes are going to go up in the future, hey, right now is a good time to focus on that Roth option. Or anybody at any age, right? If you feel that your taxable income is going to be higher in the future than where it is today, then you might also want to focus on that Roth option. I've a quick story for you here. I've got a client in which, prior to us meeting, they had really focused on saving into that traditional 401k. And they've saved up millions of dollars into that traditional 401k. Well, as we do some projections and look at, their future based on just estimated rates of growth, well, when they hit age 72, that traditional 401k, they're going to be forced to take out money, required minimum distributions. And what people don't necessarily always realize is those required minimum distributions, the rate that you have to take out that money, it grows over time. And so as we just, again, forecast, right, putting some estimates out there, as we forecasted out their future, based on how much they were saving in their traditional 401k, it was showing that their taxable income could be potentially higher than where it's at today, meaning that they could be potentially paying more taxes on that money in the future than that tax deduction that they were getting today. I find this happens a lot. So like, for instance, for them, we switched them over to now where they're focused on contributing to the Roth 401k. Everybody's situation is unique. Everybody's situation is different. This is where tax planning and tax projections come into play to understand which bucket you should be putting your money into today. But to keep it from a high level, if you think that taxes are going up in the future, or if you think that your taxable income will be higher in the future, then that Roth option, paying tax today and letting it grow tax-free so you can withdraw tax-free in the future, could be the right option for you. Everybody's situation is unique and different to them. Our last question here is from George. George says, I have all of my retirement savings in one IRA. Should I move some of it somewhere else so that I can be diversified? Oh boy, George, this is a great question because I feel that some people can get really confused with that word diversification and what does that mean? People think that they're diversified by having money, having their investments with multiple advisors. Folks, that's not diversification. Having money in, 3 or 4 or 5 IRAs, that's not diversification. And I really want to take some time to explain this to you and help you understand why. So, first off, let's imagine your IRA as a bucket with a spigot on it, okay? So there's 2 parts. How the money can come into the bucket, and I get it, money can't, go out of a spigot, but just imagine with me here for a little bit, and then how money can go out through the spigot, right? So the IRA is actually the bucket with the spigot. It means nothing in regards to diversification, but it means everything in regards to how your money is taxed. So the IRA, when the money comes in, you have not paid tax on it. Turn on that spigot, when the money goes out, you're now going to pay income tax on that money when it goes out of the bucket. So the IRA is one type of bucket. It fits in that, what we call that tax deferred column. That bucket could also be a 401k, a 403b, a 457. All of those are that same bucket with that same spigot. Money comes in, you didn't pay tax on it. Money goes out, turn on that spigot, money goes out, you're going to pay income tax on it. Another type of bucket with a spigot would be your Roth or Roth 401k. That bucket, as the money comes in, you pay tax on it, but when you turn that spigot, right, I know, weird imagination, but imagine turning on a spigot and you got money falling out of it. Boy, that'd be great, right? But when money comes out of it, all of that money comes out tax-free. And then our third bucket is the taxable bucket. That one's a little bit different to explain, but all the money that gets put in has already been taxed. Almost has 2 spigots on it. One is where you pay taxes each and every year on dividends and interest. That spigot's always on because you're going to pay on dividends and interest each and every year. But the other spigot has basically where you can turn it on and off, and that's where your short-term gains, long-term gains come in. So first off, the IRA is the bucket with the spigot. Doesn't mean you're diversified. Now, tax diversification, I just told you about 3 different buckets here, but the IRA itself does not mean you're diversified. It's how you're taxed. The next thing then is what you actually put in the bucket from an investment standpoint. That's where diversification comes from. And there's 2 layers to this. The first layer is what we call asset allocation. And I'm going to give you a lot of terms here. So if we're just focusing on growth, some people will say growth, some people will say stocks, some people will say equities. And you've probably heard me say all 3 of those different terms a lot on this podcast. Then if you're focused on safety, well, the safety side could be individual bonds, could be bond funds, could be cash. Then there's alternatives out there, right? So that's the asset allocation, right? Stocks, bonds, cash. Then under that, right? So under each of those, now you got your bucket, right? The bucket's how you're taxed. That's the IRA. In the bucket, we just created the first layer. stocks, bonds, cash. Then under each of those is where your diversification comes from, meaning in stocks, are you putting money in large cap, small cap, mid cap, international, emerging markets, technology sectors, energy sectors? That's where then the diversification comes from, and you can own different funds to be able to diversify yourself in that stock category in your IRA bucket. Same thing in bonds, corporate bonds, high yield bonds, government bonds, short-term treasuries, long-term treasuries. Again, all falling in that bond category, all in that same IRA bucket. So hopefully this helps you understand that the IRA, or having multiple IRAs, really doesn't diversify you. It's what you actually put in the IRA bucket. So I hope that helps you understand, just in regards to diversification. That hopefully also brings to you a couple different things, understanding tax diversification as well as investment diversification. Folks, I hope that you've found this podcast to be of help. If so, and you'd like to hear additional podcasts just like this, subscribe on your favorite podcast player. Also, check us out at lifemoneyshow.com. Again, that's lifemoneyshow.com, where we've got podcasts, videos, blog posts, all to help you build wealth and help you reduce your long-term tax picture. I really look forward to our next conversation to continue to help you live life today and be financially confident about your tomorrow.
Sierens Financial Group is an independent financial services firm that utilizes a variety of investment and insurance products. Investment advisory services offered only by duly registered individuals through AE Wealth Management, LLC. AE Wealth Management and Sierens Financial Group, Inc. are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. Sierens Financial Group, Inc. is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein, provided by third parties, have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Sierens Financial Group, Inc.